based here in the Boston area, and a member of the Aggregate Confusion Project, which looks at ESG measurement issues here at MIT Sloan. So what I want to do is start with John Sterman to help to put in context the climate part of the mandatory climate disclosures. So stepping out of capital markets, stepping out of this whole context of corporate disclosures, what, as a climate scientist, as someone who works on modeling and engaging policymakers around climate issues, what do you see as the current state of climate change and climate action more broadly? And how do you see the role of companies and investors who might be part of this SEC conversation versus other actors in addressing climate change?
So thank you, Jason. And so since I've been asked to say something about the state of the climate, and I'm not a financial economist or a regulator, I'm going to let my colleagues tell me that what I'm about to tell you is unrealistic and naive. And I'm not going to go into the science much. We've already warmed our planet 1.1 C, that's 2 degrees Fahrenheit above pre-industrial levels. And we're on track for 3 degrees or more if aggressive action is not taken. We also know that to avoid the worst impacts of climate change, global emissions need to fall by nearly half by about 2030, and then keep going to net zero by mid-century. This is right around the corner. Aggressive, deep cuts are needed everywhere by every nation and every company if we're to limit the warming to the Paris targets and that 2 degrees C and striving for 1.5. So that's all a bunch of numbers, but how are we doing? What we know is even after Glasgow, no nation on this planet and essentially no company is on track to cut their emissions fast enough to do that. And even if all the pledges were met for 2030, it wouldn't put us on the pathway to limiting climate change. So what's the role of mandatory disclosures here if they were to somehow come into being? And I think the most important thing to say about this is, from the point of view of climate change, mandatory disclosures don't do anything unless they actually speed up emissions reductions above and beyond what would otherwise happen. And so the question really for the panel, besides could this ever happen, is the SEC rule going to be adopted? Will it be struck down by the courts? And all of those important tactical questions is, would any kind of mandatory disclosures actually speed up emissions reductions? And so let me speak to that issue. And, happy to be told I'm totally naive about this. So one way it might help is it might compel those companies who believe, sometimes correctly, that serious climate action poses an existential risk to their business model. You can imagine these are the fossil fuel extractors and heavy industry, aviation companies that today are utterly dependent on fossil fuels and are considered hard to decarbonize. And mandatory disclosures might induce investors, employees, people in the communities in which they operate, and perhaps even their managers to take this more seriously and find a way to deploy their capital in more likely to be sustainable financially pursuits. There's definitely large organizations in that category, but far larger is the category of companies who accept the reality of climate change, think it's really important. The leaders of those companies worry deeply about the future world they'll be leaving to their children and their grandchildren, but it's just not happening very much. I'll give you a quick example. I work with a large hospital system. They have a serious problem that where they are, there's an existing regulation that requires them to deeply cut their emissions by 2030 and reach net zero by 2050. They don't have a plan. Well, their current plan is they're going to replace all the lamps with LED bulbs. So great, they should have done it years ago already. This is clearly insufficient. So why doesn't that get, and these people care, they're in the business of helping folks, right? preserving life and curing disease. Why isn't this getting more attention? People deep in the organization know that there's an enormous amount of money being wasted and energy and emissions because they're not adequately addressing a huge backlog of deferred maintenance and opportunities to upgrade the efficiency of their plant and equipment. But they're not getting any C-suite attention. And, it's understandable. The C-suite are preoccupied with COVID and staffing shortages and hospital-acquired infections and all kinds of material issues for them that directly affect patient outcomes. Mandatory disclosures could bring that to their attention, and then perhaps we get the resources that would actually let them make progress. One other way in which mandatory disclosure might help here is by revealing the extent of greenwashing that's taking place. There's an enormous amount of greenwashing in the promises and pledges for net zero by 2050 and offsets and all kinds of things that companies are perpetrating. One example is all the companies that proudly trumpet their plan to be net zero by 2050, but only on scope 1 and scope 2, and completely ignore scope 3.
Can we clarify for our audience what scope 1,
Scope
2
1 is the emissions that come directly from your operations. For example, here at MIT, when we burn gas or oil to make steam or chilled water to heat and cool the campus, that's scope 1. Scope 2 is the emissions embodied in the electricity that we use. And scope 3 is everything else. So I'll give you a positive example here. Airbus recently became the first, they claim, the first aircraft maker anywhere in the world to voluntarily disclose their scope 3 emissions, which is dominated by the emissions generated by the aircraft they make in use over a 20 or 30-year lifetime. Orders of magnitude more emissions come from flying those aircraft around than building them. And so they have voluntarily disclosed this now, but most companies are not. And mandatory disclosures could be written in a way that would compel scope 3 disclosure, and that could be very, very important. There's more to say. Do you want me
Yeah,
to?
no, let's move on. No, this is great. This puts us into context of
Can
why.
I make one more comment though? And if you're listening carefully, I think what you're hearing me say is that what's called single materiality, that is what's currently material to the profits and fortunes of the company, is not sufficient, that we also need mandatory disclosure of what's known as double materiality, which is what's considered what the impacts you have as a company on others besides your company, but are harmful to the world. I think the whole debate here, and Bob is deeply involved in this debate, contradict me, but I think the whole idea is a misnomer. In a world of climate catastrophe looming upon us, there's really no such thing as the double materiality. That is an impact a company can have on the world that doesn't have any material impact on the company. There's nowhere to hide in the world we're headed for with climate change. So I think it's a bit of a misnomer. If mandatory disclosure is going to make a difference in actually speeding emissions reductions, it's going to have to include what's currently called both single and double materiality.
Thank you, John. Bob, without this, John just said that Airbus is voluntarily disclosing their scope 3 emissions. So why do we need mandatory disclosure? What's the current state of carbon disclosure without this regulation? If with all this ESG and integrated reporting, a movement which you've been very actively involved in both documenting and supporting, do we need mandatory disclosure? What role does the mandatory part play here?
So happy to address that. But first I have to say that coming here triggered an anxiety dream.
Okay. Into the mathematics department?
It involves the mathematics department. and I had it last night. It goes like this. I'm in my second semester of my senior year. I'm one course short to be able to graduate. It's a math course. I'm going, holy shit, I don't know what the course was. I don't have the textbook. I don't know the professor's name. I haven't done a problem set. I don't know where his office is. And I've got like a week to figure all that out, or I'm not going to graduate from MIT. And appropriately enough, when I was walking down the corridor, I saw all these, mathematics professors' offices. So that triggered my anxiety dream.
I'm glad you're still soldering on.
You know, when I'm soldering on. So look, I think mandatory disclosure is a necessary but not sufficient condition. Let me draw the analogy to financial reporting. We didn't always have mandatory disclosures. It didn't happen till the SEC was formed. You know, a lot of public companies didn't report revenues. They thought it was giving information to their competitors. So investors didn't have a way to compare the performance of companies over time, you know, and across in the sector. So I think having mandatory disclosure is good, but I you know, I don't want to sound like a Cassandra here today, but I think John is right. I mean, that's only the first step, right? I mean, because all you're doing is saying, here's what the performance is, unless you've got targets, unless you've got a commitment to net zero, unless your board of directors understands this, and in my view, most boards don't. There's something called the Commonwealth Climate and Law Initiative that issued a very interesting paper on fiduciary duty. You got this whole question in the United States where ideology and law are confined about, you know, who the duty of the board of directors is to. Carol can talk about the relationships between asset owners and asset managers. That has to be factored in the mandates that they get, what they're supposed to do with companies. So it'll eliminate greenwashing. You know, it'll lay the foundation to be able to talk about the performance, just like we can talk about financial performance. But, you know, it's not carbon pricing, and it's not investing in the energy transition. And it's like a whole lot of things that we need that we don't have now. To make it worse, let me talk a little bit about the SEC proposal. It's come out at about the same time that the International Sustainability Standards Board, Bob can talk about that. They've issued their exposure draft on climate. It's 62 pages long. There's a basis of conclusions. It's about 27 or 30 pages. The SEC proposal is 500 pages. It's like, you know, everybody that cares about climate change threw in a paragraph. Well, you know, I mean, I'm not that strong, Bob. I'm a weightlifter, but I mean, 500 pages is a lot. I think it's well-intentioned. I'm working on a comment letter to the SEC with a bunch of lawyers and an accounting colleague of mine at Oxford. When I talk to the lawyers, this is going to be litigated. The Attorney General of West Virginia has already said he's going to litigate it. I wouldn't be surprised if the Chamber of Commerce litigated. I'm trying to see what the Business Roundtable is going to do. The investors want it, and it makes sense for them. The companies are the ones that so-called bear the burden. And a lot of this is whining. They talk about costs and it's difficult and blah, blah, blah. I think it's highly problematic what's going to happen here. There's a lawyer named Joe Grunfest, a well-known lawyer who's at Stanford, who was kind of part of my group, but then he's peeling off doing his own thing. He published an op-ed piece in Bloomberg, basically saying the SEC doesn't have the authority to do this. It should fall under the EPA. You've got, you know, libertarian, crazy right-wing Commissioner Hester Pierce, you know, who's making fun of all this stuff, either doesn't believe in climate change or somehow thinks markets are going to take care of it. So here's this existential issue that John is talking about, and you're going to see this get highly politicized in this country. You're going to see it get litigated. You're going to see people caught up in all kinds of details. The SEC didn't help itself with some like mind-numbing detailed disclosures that they're looking for. A big fight is going to be on scope 3. You know, the double materiality thing. What you can positive say about this is that it's for all companies. So that kind of takes care of the double materiality thing, because it's like all that carbon goes up in the atmosphere. This is a proposal that's intended for all listed companies, but you know what it doesn't cover? It doesn't cover private companies. There's a lot of private companies out there, and some of them are really large. The ISSB has got proposal, which I think is kind of cleaner in a lot of ways, more straightforward. Then you've got something called EFRAG, the European Financial Reporting Advisory Group, which is advisory to the EU. They've got the Corporate Sustainability Reporting Directive. Their exposure draft came out late last week. So you've got 3 exposure drafts out there in the world now: SEC, ISSB, and EFRAG. Want to see sort of what's similar and different. You know, with the EU, because they're a government, they can mandate it, you know, when they're kind of more down with double material and all the other stuff. And it covers private companies. And so you've got this kind of bizarre situation, in my view, where, you know, the science is pretty clear. And then the barriers to even do this basic thing, which I said is not, it's only a necessary but not sufficient condition sitting here in a math room, you know, it's not even clear that this is going to get through. And it's going to be interesting to see what companies do. Are they going to kind of bet on the Supreme Court, you know, the 6-3 saying you don't have to do it? I don't think so. I think they're probably going to say, we're going to do this and we're going to get on with it. We're going to all argue about scope 3. But then, you know, not to put too much pressure on Carol, a lot of this is going to depend upon the investment community not only pushing for disclosure, but then pushing for companies around, what are their plans? Every business model has to transition. And then you kind of get back to the board of directors. And I said, I think most of them don't get it. So I'm done fulminating. Bob, I'll let you say some positive things.
So I think that most businesses and most investors want more disclosure on climate. The question is a much more subtle and refined question as to how we're going to position that. As you said, I'm a trustee of something called the IFRS Foundation, which sets accounting rules for all countries essentially other than the US. And we've just put out a set of disclosure requirements that will invariably be adopted by most non-US countries. And a lot of US companies think they're not going to be subject to it, but they are, because it's not based on whether you're listed. Europe has already made clear if you do business in Europe, you're going to be subject to their proposals, and they will probably go further than the Sustainability Board, the ISSB. So that's the second group. And the ISSB actually does, it's in some respects stricter than the SEC. For instance, it requires that you use industry standards, but they've spent a lot of time, Bob spent a lot of time, Bob Eccles, developing these industry standards.
Isn't that an irony? SASB is at the core of the ISSB, and it's an industry-specific materiality, and SASB stuff isn't in the SEC proposal.
Yeah, no, that
It's
would
nuts.
it would make a lot of sense. And the ISSB also says you have to do scenario analysis unless you're unable to do so, and it has a complicated set of rules. But the SEC proposal, the biggest problem is the whole question of how they define materiality. And they recite the traditional rubric. I was an SEC official, so it's, do you affect the mix of information, materially affect the mix of information that investors need to make investments? And so they recite that many times. But when it comes to scope 1, 2, and 3, they essentially say you have to disclose scope 1 and 2, regardless of whether it's material. And then they say you have to disclose scope 3 if it is material. And that sounds on its face reasonable, but then if you look at the release, they say, the SEC says that many companies use 40%, meaning that if scope 3 is greater than 40% of your total emissions, then it's material. Now, I would say almost all industries other than electric utilities, scope 3 is more than 80% of their emissions, because scope 3 includes all your customers and all your suppliers. So it seems to me a bit of a sleight of hand to say we're not requiring scope 3, because I think they practically, as a practical matter for most industries, are. And I think that point will be heavily litigated. The ISSB takes a much more flexible approach and leaves it up to each company to decide whether or not it's material. And it sort of has something, I guess I see it as sort of a blend of single and double materiality. They call it enterprise value, though I'm not sure exactly what that means. But so I think there clearly will be lots more disclosure, and it'll be more comparable, which will be good. The fact that people have to disclose their targets and metrics, that will have I think we'll move toward what John wants, that people will start to take these more seriously and do it. But I believe that because of this issue of scope 3, this will be litigated for several years. And, that's why the document's 500 pages long, because they're already litigating the case. So I think it's most unfortunate, and I think that's sort of where we are headed. And the the second thing is you would want all these different disclosure requirements to be aligned. I mean, one thing that business is going to complain a lot about, and so are asset managers, if you have 3 different sets, they're similar, but not the same. And ability to have alignment is really important. And I'm not sure that's going to happen because each group thinks that what it's doing is better, and et cetera. Last thing I'll say, and that's a lead into Michelle, is the SEC for years has defined materiality in financial statements as using a 5% rule. But they say in this release, if your climate risk and climate plans and various climate things exceed 1% of any line item, meaning all the different requirements that the SEC has for companies to disclose, then you have to disclose that in a footnote, and Michelle can explain more why that's going to be problematic. So it's no doubt in my mind that we're going to have a lot more disclosure on climate risk. The questions are, how are we going to deal with scope 3? Can we figure out, as Bob says, there are a lot of private companies in your supply chain and in your customers. And so, and a lot of companies don't have much control over what happens to what their customers are doing. So some of them may not have the ability to even get the information, but they probably will over time. So I think that that's where the whole focus is going to be. I believe it was just scope 1 and scope 2, we would have we'd have an agreement and we'd have an alignment. The question that I think all of us have to grapple with is what's a useful and feasible way to approach scope 3. And let's see if we can get these 3 different bodies to come up with the same solution.
Thanks, Bob. Michelle, I'd love to talk about the sort of practicalities of getting this done from an issuer perspective. A couple of these issues have already been raised in terms of how much control do you really have over getting the data that you would need from people in scope 3. And that's just sort of getting the data you need. There's a whole other set of practices or processes of attestation, of auditing, other things that are required when you're going to do a mandatory disclosure. So how should we think about the strengths and weaknesses from that kind of efficiency and effectiveness for the issuer objective?
Yeah, thank you. And thank you for inviting me to be here. These are really interesting questions. So I think in terms of the scope 3, kind of follow up on what Bob was talking about, scope 3 is a significant departure from what the SEC has normally required. In other words, scope 3 is all the emissions, basically greenhouse gas emissions from the value chain, both upstream and downstream. So these are third-party emissions. And this is quite unusual for the SEC to require companies to disclose so much third-party information. And on top of that, what Bob was talking about is the materiality. It's not quite clear what is material. Normally, the SEC would say something is material if it affects a decision maker, in terms of their investment or their vote, say, for example. And 5% is kind of a benchmark rule of thumb, but it's really will it affect someone's decision? And here, they're in the scope 3, they gave, well, some companies use 40% kind of thing, but it's quite clear in their narrative that they want companies to disclose scope 3. Small public companies are exempt from scope 3 as well. And then the way they've implemented scope 3, it goes by time. So there is a transition period. Companies have time to get this in place, and that part is reasonable. But how companies are going to come up with their scope 3 disclosures, I think they're going to have to use a lot of consultants. Consultants are going to make a lot of money off of these disclosures. There's no doubt. So I think it is very complicated.
The qualitative, if you don't meet the quantitative standard, then they'll hit you on qualitative materiality.
Yes, and if you claim it's not material, you have to explain why it's not material. So they clearly, I think, want companies to disclose scope 3, but that's very difficult because you need upstream and downstream all your value chain. And if you think about in aggregate, all the financial statements, then it's going to be a lot of double counting across those statements, whether or not people care about that, but that's something just to be cognizant about. The other item that Bob was talking about is the financial statement metrics. And what that is, those are your physical risks. Say if a hurricane, what are the odds a hurricane affects one of your physical locations, or your transition risk, meaning what if a regulation changes in the future and that's going to increase cost to your company, something like that. Or it could be opportunities, maybe I'll come up with some technology that will, decrease greenhouse gas emissions or something like this. That would be an opportunity. And so companies are required to disclose these, like Bob was saying, on a line item basis. So every line item on your financial statements, companies will have to go through and they have to provide disclosures about both narrative, how will these work? How did I come up with these estimates? And, what effects on my financial statements will these risks have? And then in the notes to the financial statements, they also need to disclose it by amount, like Bob was saying, by line item. And the materiality threshold for that is 1%. That again is a big divergence from how the SEC normally operates, which is managers decide, is this item material? Meaning, does it affect, people's decisions, investors' decisions on whether they vote or invest? And so this is a big departure to give such a bright line test like that. And that 1%, it's 1% of that line item. And you might think, well, what if they have a risk that's $80,000 and an opportunity that's $80,000? Maybe that should be zero. But no, it's absolute value. So if you have a risk that's $80,000 and an opportunity that's $80,000, that's $160,000. And so that's how they're going to measure the 1%. Okay, so now you have to think about managers have to try to estimate all these things, every line item on the financial statement. Then you have to think about the auditors. They have to attest to this because this is in the financial statements. This goes in a note to the financial statements. So now you're thinking about auditors trying to figure out, understand climate risk. Okay, that's not something normally taught in accounting programs, but they will now, I think. The firms are upskilling and hiring a lot of people to try to.
We heard a factor of something like $10 billion being invested by the PwC, Ernst & Young, KPMGs of the world.
Yeah, each,
right, to build the capacity to do this.
Yes, but they're going to make quite a lot of money as well on all of these disclosures. So these are, divergence from the SEC's normal practice, which you may or may not agree with, which is fine, but it's going to be a change, for companies. And this is a lot of uncertainty. If you think about what they're required to disclose in the narratives, it's how will these climate risks affect my strategy, my outlook, my financial statements, my business for the short run, the medium run, and the long run. So now you're thinking about managers thinking 20, 30 years out, and how will the climate change affect my business? I mean, it's just like an astronomical amount of disclosure and estimates that these firms are required to make. So I think, kind of back
We
to.
don't even know what short-term, middle-term.
You're right. They didn't
long-term
give us years. So
mean.
each manager has to determine and disclose what they're defining as short-term, medium-term, and long-term. That's right. And, kind of back to what Debbie was talking about, disclosures do come with a lot of benefits. Certainly, we know that from the literature, and some of my colleagues here have worked on this too. It will reduce information asymmetries. It will cause managers to learn, and it will provide information to stakeholders, no question. But it's not costless. The normal costs we think about with disclosures, there could be proprietary costs, there's compliance costs, and there's certainly litigation risk. So, in terms of the compliance costs, you can imagine this is going to be massive amount of compliance costs to come up with these estimates and to disclose these and then to audit these. And I appreciate the fact, that the SEC actually decided to follow the TCFD, the task force on climate related financial disclosures already that's in place because some companies voluntarily disclose those. So what they're saying is if we follow this, this will mitigate some disclosures. And that's true. And I appreciate that. But I think it's also important to recognize that companies, even that say they follow the TCFD, do so in a kind of pick and choose way. So if you look at the data, Moody's just did an analysis of financial statements. And basically what they find, especially with US companies, is that not many disclose many of the provisions in the TCFD. In other words, some companies will disclose some parts, some companies disclose other parts, but it's I don't know if it's any companies that fully comply with the TCFD. So this still will have a lot of compliance costs. And, before they were disclosed in sustainability reports, but these are going into 10K, this is like the real deal. So they're going to have to be serious about this and get it audited and some parts of it.
Let
and
me
things
just
like
jump
I
in by
think-
saying
go
there is in the SEC proposes a safe harbor for scope 3 to some extent.
to some extent. Yeah.
But it actually goes out of its way to point out that that safe harbor doesn't apply for initial public offerings and other documents. So I think that would be a way to pay to sort of ameliorate some of the litigation and some of the fights that are going to be if there was a reasonable safe harbor.
That's sort of a safety valve here on the cost and litigation risk. But let me, Michelle, I'm going to put it to you more strongly. Has the SEC overstepped its bounds here?
Well, I'm not a lawyer. I don't know, but there is a debate. So
Okay.
the debate, I think, if you think about what the SEC's mandate is, it's to protect investors and to foster fair and efficient capital markets. So it's quite a narrow mandate in a lot of ways. And so the question is, are these disclosures in line with that mandate? If the disclosures were to mitigate, to disclose financial risks that the company has, then that would be in line with the mandate. But are all these disclosures really about financial risk? And what the two sides of the debate will say, let's say the people that would say that the SEC does not have authority, what they would say is that they don't have authority. This is really about climate policy. And does the SEC have the authority to make disclosure requirements that are really about climate policy, not about financial risk? In other words, do these disclosures really tell me as an investor about the risk that this company is facing and that will change my investment decision about this particular company? Or are these disclosures about climate policy in general, trying to get companies to not emit so much greenhouse gas? And so this is the debate. And, one part of the debate, like you mentioned, were the other actors, but one part you could say is maybe Congress should enact this. And then once Congress enacts it, like mine safety or something, they came out with disclosures in the Dodd-Frank Act that the SEC had to require disclosures about mine safety.
Mhm.
And so then the SEC had to require disclosures, but Congress mandated it. In this case, Congress has not mandated it. So some people wonder whether the SEC has overstepped its bounds.
The lawyers I'm working with think they have.
Okay.
And it's a very distinguished group of lawyers, including the former Chief Justice of the Delaware Supreme Court. And it's like, they feel that what the SEC is trying to do with everything that's in this is kind of make up for the lack of decent public policy.
At the congressional level, and that may not be its job. Yeah.
That's right. And it's going to come a lot down, as Bob was talking about scope 3.
So, Carol, from your standpoint as an asset manager, what does this look like to you? There was one call that said, hey, Bob said, hey, Carol, we're going to need you guys to push a little harder for this to happen, given the headwinds. Michelle said, if we're just evaluating risks at the company level, that's one thing versus maybe this universal owner perspective that's talked about a little bit in the investor world that says we need to look beyond the risk to an individual company and try to think more broadly about risk to society. How do you think about what you would like to see from disclosure and the role that, the sort of cost benefits and unintended consequences of this particular proposal?
Yeah, just following on everybody's comments, just the complexity is clear. There's no question about it. And I would say from an asset manager's perspective, we're incredibly, probably table pounding to a certain extent, supportive of this. And, for a number of reasons, which I'll cite, but we believe climate risk is investment risk, period, end stop. And that it is absolutely critical that we have the kind of information that we expect from an issuer to have that dialogue with us and be transparent and consistent with information. We are not a public company, however, we're owned by one. And so what I'm telling you now is that we are all running around doing so much of this right now. The tsunami of information and requests that are coming from investors demanding information today, and this has been a buildup for years, is tremendous. So the fact that there's a potential to have clarity and consistency, as everybody's talked about, would be incredibly welcome. Because right now it is a tsunami at every level you can imagine. I would also say that, from our perspective, good news, bad news, or maybe I see this as the really exciting part of it, is we are in the greatest transformation of how capital is going to be allocated in the future. It is changing massively. So the idea of going from a shareholder-focused world of how you think about companies and what companies are obligated to do for investors to a stakeholder world. And that might sound idealistic or pie in the sky, but it is happening real time today. And you're seeing it not only from what investors expect, institutional investors, retail investors, but clearly from consumers, that they want to make sure it's not just about how much money you make for me. It is also about how you are going to make it. And so we're seeing that very clearly. And what I would say is, for us, it is completely aligned with being a long-term, not a short-term, a long-term active manager. And when we say long-term, we're not worried just solely about greenwashing. We're worried about long-term washing. Everybody says they're long-term. No, they're not. And so I think there needs to be a lot more accountability, not only for disclosure, which is great, and consistency of disclosure, but then the reality of the transformation that is going to take place and has to take place, and the time that it's going to take to do that. We like it because of the accountability and consistency and more transparency, because right now it's a free-for-all. And for us as active managers, we see this as much better ways to have more deep engagement with companies. We're already doing a ton of engagement, but right now we're demanding and table pounding on more disclosure.
Mhm.
So if there's more disclosure, we now leapfrog right into engagement around strategy. And because our average holding of a stock inside a portfolio is not a couple of months and it's not a couple of years, it's 5, 6, 7, 8, sometimes 10 years we're holding a stock inside our portfolios. So we want to spend a tremendous amount of time on strategy. We want to figure out which businesses are going to get this right. Who's going to have the competitive advantage to actually really position their company for future change? And then we want to be standing right beside them, measuring progress and holding them accountable. And by the way, it's a lot more than just proxy voting. We also are a global asset manager. So if you're global in any way from any business, you're dealing with these requirements all over the world now. In Europe, their mandatory reporting, we're all stepping up to do that today. And in a lot of ways, we're just keeping our fingers crossed, to Bob's point, about more harmonization and consistency around the world, not just within the United States. We do think it will be any disclosure, any consistent disclosure will be a better baseline for measurement of progress. So if we are going to hold public companies accountable, we've just got a better way to hold them accountable for the progress that we all expect. I think the other realization is we've all signed up for net zero commitments. So we're all in a position right now, whether you're an asset owner, whether you're an asset manager, whether you're a sell-side broker dealer, whether you're a public company, everybody signed up for net zero commitments. So we are having to disclose this information today. And as an asset manager, we are having to roll all of this up to a portfolio level. So the easier the data is at the issuer, the easier it will be for us then to disclose at the portfolio level. I guess I'd finish by saying the cost and consequences. I don't think, and everybody said this, we can underestimate, and we're seeing it within our own organization about holding ourselves accountable for our corporate behavior. Because not only do we, if we're going to hold public companies accountable, we do not want to be hypocritical and not hold the same mirror to our own behaviors, but we are also owned by public companies. And what I can tell you is you cannot underestimate the skill and the investment and the commitment you're going to need to make to the resources to get this done well. And that is experts, and that's resources, and it's committees and attention and governance structures that many of us don't have today. I do think consequences could be investor confusion. And, I couldn't harp hard enough on the scope 3 issues. They are so massive. And yet, if you talk to our investors, they want it as they would say mandatory for everybody. And yet mandatory for everybody means a lot more clarity. And then I guess the other thing that probably worries me about the public markets is the pressure on public companies, and the fact that this is not in the private markets is once again another hit on why go public, which is devastating. That should bother everybody. It's not against any of the private companies, but that should bother everybody. And I do think this is what I'm hoping is a challenge to the investing world, that should we be also looking at the limitations of just investing around exposure, that I'm going to make money off just exposure to risk versus responsibly owning a company, and what that takes to own a company responsibly and engage in the kind of time and capital commitment that you need to give public companies to do this well. So
I mean, that point on engagement is really interesting, that right now, so much of the engagement is on asking companies for disclosure. And one of the effects could be, if you free everyone up to ask for that because the government's asking for it, now all of a sudden you can engage firms to set targets, to actually reduce their emissions, go from that sort of necessary but insufficient conditions to some of those sufficient conditions. I think that's, I just want to reinforce that because I think it's
and
important.
that's what I would loop back. We do think that we're spending too much time doing that today.
Asking for disclosure.
Yes.
And then the other thing I just want to reinforce is what you said about public companies versus private companies. And there's two effects there. One is that companies might not choose to go public because, I'm going to be subject to like so much complexity of reporting and everything. So I'm just going to stay in the private markets and then be opaque to the world in terms of this kind of transparency. The other piece of the puzzle is, if I'm going to have to show my emissions, maybe what I do is sell off my most emitting business units into the private companies. And then we can hide all the emissions in the private markets and not have them see the light of the day in the public markets.
Outsource.
Exactly.
Yeah, through outsourcing, through sell off of.
The dirty asset just goes somewhere else.
Exactly.
And it doesn't become
At
accountable.
pennies on the dollar, and then it makes it easier to keep it going for decades more. So,
That's right.
but so there's a public good story here. Michelle and Jason, you quoted 10 billion each by the big accounting firms to develop the capabilities to do this. If that happens, and I think some way down that road is definitely going to happen, that creates the ability for investors and others, owners, employees, activists, to demand of the private companies that they use those tools once they're in place, because all the development costs will be sunk and the marginal cost of doing it will be lower. And, I just would remind people that within living memory, there were no national income and product accounts, no psychometrically valid ways to measure customer or employee satisfaction, no net promoter scores. These things came into being because people saw the value of reliable measurements, because those issues are important. I think people are very creative and are going to be able to come up with ways to measure what matters here. And it'll end up different than what people are talking about now in a 500-page document. But that's a really important capability that we've got to invest in as a society, and mandatory disclosure regulations could accelerate that beyond what's happening now.
Yeah. I want to, so I think we've got the basic issues into the room here, and I want to go and engage with our audience, because both in the room and online, we have some great folks from the investment community, from the MIT community, and I want to open this up for some Q&A so folks can raise their hands, or if we've got people who are on the online and can convey some of that and filter it, that would be great. Yeah, Jeremy.
Yeah, just about the discussion about scope 3 and materiality, like I understand it very much on disclosures. It leads me to also think though about taking action, which of course is what we want. And it leads to an interesting decision though, but like kind of going to Airbus, your example there. So Airbus, let's say they say they're going to offset emissions of their customers. Does that mean their customers are then off the hook of that, right? And right now, I think the good thing is because we're in the early days, we hear both Airbus and Delta and whomever saying you're both going to do it. And I just would be curious to hear thoughts of folks, if you have encountered that differently, if people are saying that, or how these disclosures might affect then kind of allocating. We're asking for reporting on scope 3, but there isn't also, it seems outside the purview for the SEC to say that who takes action based on that reporting.
So just in case that didn't pick up for the remote audience, when we get to scope 3, how might this affect actions that are taken when you have sort of overlapping responsibility, particularly like between an Airbus and a Delta? What are we seeing and what might we expect with better data? Any thoughts on that?
I could give an asset manager. It's interesting because, this is why there is a lot of pushback on scope 3, because the clarity is, so Sun Life of Canada owns MFS, public company. So obviously we're going to have to report as a piece of Sun Life. And then the question about what we're reporting is it is actually MFS's climate picture, or does it also pertain to all of our portfolio companies? And because those are actually the products that they're using the greenhouse gas protocol. So really define whether that applies to our products, which are portfolio companies.
I think one of the important ways to look at this is who has control over the extent of the emissions. In scope 1 and scope 2, it's within your control. But depending on how scope 3 is operates in a particular company, you may or may not have any control over it. For instance, if you produce an airplane, presumably the airlines can fly them differently. They can have different types of fuels. They can do different things. But you, if you're the manufacturer of the airplane, don't control those things. So at least in my mind, I think we have to focus on who has the ability to change the emissions. And those are the people who should have the responsibility. You can't ask Airbus to change what fuels are going to be used and how many airplanes people are going to use. They could create some.
Airbus is actively, and all the other aircraft manufacturers are actively trying to figure out what kind of genuinely carbon neutral fuels they could use and then redesign accordingly. And that would also include the engine manufacturers. And there's tight, deep partnerships between the airframe and the engine manufacturers. So I agree with the point.
You're right.
Who's in control matters.
But
I think you're going
they
to
have the ability to redesign the engines, and that's within their control.
Right. So you're going to really do this, you're going to need partnerships across the links in this supply chain. And Jeremy, your question, maybe you didn't mean this, but people might say, well, if we're going to hold people accountable for scope 3 in aviation for Airbus is scope 1 for United Airlines, you'll be double counting. I'm really not worried about that because it's totally undercounted today. It would be a great day if there was a fight over double counting and then, responsibility was apportioned. We're nowhere close to that right now.
We had a question from online.
Okay, yeah, actually 2 great questions came in. So the first one is, I know the SEC now does more cost benefit analysis. They have to. And have they done a cost benefit analysis of this regulation and what did they conclude?
What's the cost benefit analysis that's been done within the SEC or that we anticipate?
If you read the release, you'll see they're required at the end to do a cost benefit analysis. And they'll tell you, it says at the end of the release, what they've done, whether you believe it or not, whether you think it's done properly or not, I don't know. But they're required now under various OMB rules to do a cost benefit analysis.
I think they're vulnerable in that regard. I mean, the numbers that they've got in there. So
Could you have a mic just so that we get that?
So I mean,
Thanks.
I think they're vulnerable in that regard. The numbers they've got in there are so low in the amount of analysis. From what I can tell, they've done, there's a report that's going to come out in a week or so that another group has done of a survey. And the numbers that they've got are much bigger. It doesn't mean they shouldn't do it, but like a factor of 10, from what you see, in the SEC.
I agree. That's a point of vulnerability.
Just quickly paraphrase the other question. The question concerns what investors really care about is the delta to measure if a company is making progress over time and whether the nature of these disclosures is really going to be good for capturing that. Kind of, are we seeing, is it measuring what we want to see from the companies we invest in, which is progress, not just getting to net zero,
Yes.
but how are we going down that path?
Mary Carol, we'll start with you on this. Like, to what extent do you care about kind of the absolute value versus the delta or the first?
Yeah,
Since we're in a math classroom, the first
super
derivative.
important. I mean, that's the whole point of being able to have meaningful engagement is to really have that baseline and then be able to measure progress along the way. Because again, as long-term investors, we think this is going to take time. We don't want it to take forever, obviously, and we want it to be sped up. But I think being able to measure that progress from year to year is going to be super, super important. It also presses what I think you start getting good at really as an active manager, and this applies to everything, but it's a sell discipline around climate change.
A selling discipline.
A sell discipline around climate change, who is not making the progress that you need to see. And if they're not, they're going to be at a competitive disadvantage and you are likely not going to own them. And again, that is not exclusion or divesting for the sake of getting a dirty asset out of the portfolio or decarbonizing too early. It's actually partnering with firms that are actually going to do this well. And I think it creates a competitive advantage or disadvantage for companies.
Interesting. Yeah, Michelle?
I think probably even the voluntary disclosures have gone some ways to getting that done, because companies now, like I'm thinking Procter & Gamble, I think they have a nice chart where they show, we had goals that we put in place in 2010. How did we do by 2020? And they show nicely, I think, how far did they come in reducing their emissions? How far did they come in doing these other actions that they had set in their goals? So I think that's a good example of a type of disclosure where you would see a company disclosing their progress toward their own stated goals that they had.
Yeah, I mean, there's some nuance in that because sometimes what you'll see is progress looks like the emissions actually going up because they're getting better at the accounting, right? We'll see, like Walmart wasn't disclosing any Scope 3 emissions up until the point that they were. And then they put that number on the board and all of a sudden it looks like it's bigger, but it's actually getting a little bit of visibility.
Yeah, you would need it to be comparable to be informative. That's true.
Well, and you need consistent standards and they need to be science-based. And despite many people understanding the principles of the science-based target initiative, et cetera, a lot of companies are still not reporting it. They report the improvement in the emissions intensity. So emissions per dollar of sales or per employee or per iPhone sold. And that doesn't matter at all to the climate. What counts is absolute emissions. And, you easily, even nations do this. China promised in Copenhagen in 2009, they'd cut the carbon intensity of their economy by 2020 by 45%. And meanwhile, their economy grew and was expected to grow even ex ante at that time by far more than that. And their emissions, of course, grew. And but 45% sounded like a lot bigger number than the 10 or 11% absolute emissions reduction that the United States was putting on the table. And so it made us look at.
But
So
that's
you could get rid of these kinds of inconsistencies and
Through
greenwashing
yeah.
nonsense.
But
You're
that's a
spending
good
a lot of
example of
time on
what
it right now.
disclosure standards do and don't do. Right. I mean, it's not going to say you've got to use SBTI when you set your targets. The company will choose whether they're going to do that or not. Then they're reporting according to that, or they're reporting to according to something else. The standards aren't going to set targets to say that you've got to reduce absolute emissions. They're just going to say, we're going to give you a consistent measure that you can believe, just like you can believe a company's revenue. Right.
I don't actually believe the SEC rules require that you have targets.
No,
They
they don't.
say if you have targets,
You have to disclose.
Yeah.
And
disclose
they
it.
can't. They don't
It's-
tell you targets for what your financial performance
So-
should be.
It's similar with internal
Right.
carbon pricing. If you have internal carbon pricing, it says to disclose them. It
Yeah.
doesn't say you have to do internal carbon pricing. Yeah. There were a few hands that popped up in the audience. Let me go in the back there.
Whether SEC has overstepped their boundaries, could you, one, explain a little bit more about how the site says that they have does not see financial risks as equating with climate risk?
Mhm.
I'm trying to understand that side better, that they don't see that there's a connection between financial risk and climate risk.
Okay, so for people who, I'm just going to repeat the question for the remote audience. So if we say the SEC has overstepped their boundaries because the SEC is supposed to be focused on financial risk, does that mean that the people who are saying it overstepped the boundaries are those people saying that this is not really a financial risk, therefore we don't that it's we shouldn't care about it from an SEC perspective, or is there a different kind of argument behind that overstepping of the boundaries?
I may be the only lawyer on this panel with a law degree. I think that's not what's being said. I think what's being said is sort of what Michelle was intimating is historically, we've looked to see you should disclose the things that bear on this specific company's operations, its strategies, what it's doing, this specific company. And people who think the SEC exceeded its authority are basically arguing that many of these disclosures, including scope 3, seem to go beyond the things that are specifically impacting this one company and seem to be more geared to what's happening in the larger society.
Yeah, it's a level of analysis thing, right? You know, it's like the individual coming to the portfolio versus system level. So Carol can be right at a system level, but a lot of people would say that that's not within the remit of the SEC. And you've also got the problem of typically, and this is, look, you're the lawyer, but what are the boundaries, you know, upon which the reporting is based? And when you get into scope 3, you know, you're outside the boundaries of the firm, you know, and I think that's another vulnerability in that proposal.
Yes.
Definitely. Yeah.
And Bobby bring up a really important point because the question, even at the institutional investor level or asset manager level, are you trying to decarbonize your portfolio? Or are you trying to decarbonize the economy? And, you know, I think today the answer, if it's just your portfolio, we got a problem. And yet, if you're a fiduciary of a public planner, you know, they're seeing, you know, how big is my scope? And how do I meet that fiduciary responsibility just in my purview?
Yep. Rodrigo, you had a hand up.
Yeah, so I mean, a lot of the discussion here was about the challenging measuring scope 1 versus 2 and 3, and this whether it go beyond the front. Right? So go back to John's point in the beginning. John said this disclosure is just going to be helpful to the extent they actually accelerate cutting emissions, and you said a few channels like could alert the C-suite, you could have greenwashing discipline, have reputational consideration. So if I go back to those channels, how do you think of scope 1, 2, and 3 as having the potential to enhance those channels? And then just say one more thing. There was talk about potential double counting in public firms and these private firms hiding, right? But to the extent that scope 3 can tap into this beyond the public ones, could there with action, like it goes beyond public firms implications. So how do you measure the challenge with the potential?
So can I tell a really quick story, I think relevant to this? So in 2012, MIT got together with other universities here in the area, and they decided they were spending a lot of valuable campus real estate and electricity supporting their high performance computing. So we all got together and we invested in what's called today the Massachusetts Green High Performance Computing Cluster in Holyoke, Massachusetts. And in many ways, it's terrific. It's designed to be super efficient, has a high power use efficiency metric. It uses cold air in the winter to cool the servers. And all of this is great. But in the initial press release, when it was launched, they said, and all the electricity for it is carbon free because Holyoke has a municipal utility with a hydro dam. That is a scope 2 or 3 issue because building that center out there didn't expand the demand, the capacity of that dam 1 kilowatt hour per year. And so all that happened was they put out a fundamentally misleading, not to say knowingly wrong, press release claiming that they were getting green power to run this place, when all they did, to the extent they got power from the hydro dam, was force some other customer in the Holyoke service area to get their electricity from the marginal source of power in New England, which is natural gas. Emissions didn't go down by 1 ton of carbon, but it was claimed. And I persuaded our then associate provost to take that off the website. But, you know, disclosures could maybe prevent that problem if they force you to address scope 3.
What are some other, any other thoughts you guys had on how the disclosure might drive change in scope 3? I mean, one thing that occurred that I just want to reinforce something that John said early on, which is that disclosure, investors are not the only audience for disclosure. Once you build the infrastructure for disclosure and companies put this information out there, customers can also use it. Employees can also use it. And those are also channels for action where now all of a sudden, if I'm, you stick with the Airbus example, it's not just the investors in Airbus who will see those emissions, but the Delta Airlines and the end consumers of Delta Airlines who might say, hey, what kind of plane am I flying on? I want to be on the most carbon efficient flights. And Google Flights now tells you the relative carbon emissions of different flights based on some of this information. So it opens up, some of this information opens up channels of influence on companies beyond investor action through engagement or portfolio construction. Yeah. Okay. Go ahead in the back there.
Or private versus public firms. Comment on how the SEC disclosures affect bank reporting and that they then provide to private firms that are polluting, and whether that might be a channel by which these disclosures can maybe prevent spin-offs from the public sector to the private sector.
So when a bank that provides debt capital, provides lending, is subject to these kinds of disclosures. Well, but let's say that they are, right? Let's say that there's a publicly traded bank, right? Like Bank of America or Wells Fargo, right? And they are providing lending capital. If these disclosures required them to make more visible the carbon impacts of their loans, and I think that's an open, I don't know the answer to that question, but let's explore that. Might that be, if they're lending to private companies, might that be another channel of sort of expanding the impact of the rules into the private markets?
I think that there is a possibility of doing that. It might come more from the bank regulatory agencies than from the SEC, because all the SEC can say is you have to have this disclosure, and so then the SEC, then the bank or somebody can try to get it from somebody else. That's, they'll have fights about who's going to supply the information or whether it'll be done. But the bank agencies, and that's another big fight, is, they could say, we think this is part of the loan risk that you have. Is the borrower going to potentially default because they're going to get sued, or they're going to have problems meeting, the European standards or these sorts of things. So I think that people say that scope 3 for banks is something in order of magnitude of 700 times higher than their own. So it's huge. But I think the more likely way for that channel to be done is through the bank regulators requiring banks to go through a process of analyzing the climate risk involved in a loan. That's what I think.
I mean, look, it's a good question, but your answer is just, to me, Bob, another example of, I think this is trying to just expect the SEC to do too much.
Yeah, it is.
Right.
Michelle?
I was just going to say insurers too, I mean, normally, I guess when I started looking at all these, years ago, it's like, it's interesting to think about banks and insurers, right? Because they have these long-term insurance contracts or a long-term loan, and they want to know the climate risk, not just the greenhouse gas emissions, but the climate risks that are facing these businesses, or different things that they might insure or give loans to. And so you can see why that'd be an important disclosure to those entities. So I think it is a good question that you asked.
Yeah, go ahead.
So I think just staying with the banking example, I'm looking at a parallel with the Basel requirements that the justifiable requirements in which they have to maintain certain ratios. It's a complex calculation of the risk inherent in the bank's asset book, and which requires them to maintain a minimum tier 1 capital ratio of 8%. So could there be parallels into the climate terms, where you're inherently looking at the risk within a company and expecting that they maintain a certain buffer, so to speak? So it's a way of expressing risk attributable to climate for companies. I don't know, I guess in the absence of a carbon price.
So the whole question is which agency is doing it and what's their objective? If it's a bank regulatory agency, it's really worried about whether or not there are going to be a lot of defaults, what the loan loss reserve is. So whether and so to the extent climate risk bears on that, then they have a legitimate reason for knowing this. But on the other hand, it could be, I don't know, I'm just making this up, a 3-month loan. So climate risk doesn't make a difference. So you wouldn't want to have, the bank regulators aren't going to require this for every loan. They're going to say if it has an impact on repayment and pricing of the loan. And it may very well.
Plus, there's the reality that it's a Democratic bank regulator, that person's going to think one way.
Right.
And if it's a Republican bank regulator, they're going to think it another way.
Well,
and I don't think we can ignore that dimension in this country.
You just had a woman who was withdrew as vice chairman of the Fed because she suggested that the Fed ought to have an aggressive position on asking banks to do more.
And there was too much pushback from the Republicans.
And also Joe Manchin.
And Joe Manchin. It's always fucking Joe
What's
Manchin.
happening at the state level too, I think.
Yeah.
Okay, other questions? Yeah, go ahead.
Yeah, Nimit has one more.
Oh, there was, okay, good. Yeah, no, go ahead.
So it's interested in the cost benefit analysis that the SEC conducted, but part of it feels like has to go back to climate science, right? And trying to climate science, in my naive understanding is, while we have definitive evidence that planet is warming, what is less, at least is greater uncertainty, at least for my colleagues at Sloan, is what are the implications of planet warming by, say, 2 degrees? What are potential adaptation measures that, say, all the creativity we have for measuring, say, scope 3 disclosures, what about creativity and adaptation conditional on the climate warming? And again, isn't some of that one has to feature in this cost benefit analysis? That's partially it. And then the second thing is for disclosure to have implications out of it, feels like compensation, managers' compensation of people in the asset management industry, that has to change, must be tied to metrics related to disclosure. And do you see that happening?
So let's take these two questions
the first
separately.
part of
then.
that, if that's okay. So first of all, we're not on track for 2 degrees. We're headed for 3 or more. And, pledges and promises are just that. They're pledges and promises. And until they're backed up by actual action, they don't mean very much, if anything. And a world of 2.5, 3 more degrees of warming is not a world in which people are going to be making a lot of money in public companies or anywhere else. And a lot of people are going to die. So and yes, there's uncertainty about the impacts, But uncertainty is not your friend here. Uncertainty means here's the expected effect, and it could be a whole lot worse. Yeah, sure, maybe we get lucky, but it could be a whole lot worse. And markets and companies hate uncertainty. So the price of carbon should be even higher in a world of uncertainty than in a world where we know exactly what might happen. And the same with disclosures and regulations.
And your example of the hospital, which is great. If the hospital board decides to focus more on climate issues, which comes at the expense of, say, patient care, which you contrasted, that you can measure patient outcomes right now, less uncertainty. And I understand outcomes can be worse, it can be better, but how does that feature in this cost benefit?
So I reject the predicate that there's a really hard trade-off here that, I mean, people do make the argument, you know, Mr. CEO, Ms. CEO, if you invest more in these maintenance issues and efficiency upgrades, children are going to die. But it's not really a hard trade-off. And you want to think about all the people who died in the hospitals of New Orleans after Katrina, which was amplified by climate change, and how much worse that's getting now everywhere. The opportunities here to ease that trade-off and save lives are great, but nobody's focusing on it now because they don't have to, and they have these, I would say, incorrect mental models about the hard trade-off.
Bob?
Well, I think when we talk about the SEC's cost benefit analysis, it's a different sort of cost benefit analysis. They're under an obligation when they put out disclosure rules to talk about what's the cost of generating the information and putting out all these rules relative to its benefits. So it's very company specific. And as Bob says, the numbers they came up with, first of all, the whole area of cost benefit analysis for SEC rules is pretty fuzzy, to say the least. And in this area, it's not even clear exactly, you know, what benefits we're talking about. The costs are information gathering, attestation, these sorts of things. So at least we know that. On the compensation.
But they don't know that either, really.
Right, they know, yeah, they don't, they don't use, if E&Y is spending 10 billion, they don't seem to be putting that 10 billion up. But on compensation, that's an interesting point, because I've always felt that unless executives at companies have part of their compensation tied to these metrics or targets, then a lot of this is just, you know, it doesn't make any sense. You're saying you're being compensated on revenues and earnings, but somehow all this other stuff you're supposed to be doing. The SEC decided in its release that it did not put out a specific requirement for compensation. It said that it thought that its general compensation rules cover this. And what I think they meant was that if you have you know, a greenhouse gas target as part of your compensation, then you'd have to explain it in your proxy statement, but they're not requiring it. By contrast, the ISSB proposal does require that you look at your compensation structure and disclose what aspects of your compensation structure are tied to any of these targets, which in my view, if you don't do that, then it's a bit of a joke.
And that's compensation at the company level. The question is also about compensation at the asset manager level. So, you know, kind of the incentives that you face, Carol.
Yeah, I mean, and I think it all trickles down to the company level. You're starting to see it already. Compensation being tied directly to transition success. It also, from an engagement perspective, when we are engaging with companies, it's, you know, the executive compensation conversation has been going on for a long time. And so now it's not just about disagreeing or voting against what you're making, it's actually disagreeing or agreeing with how you're going to get compensated. And I do think having executives tied to transition success is very real. And I think it's one way as an asset manager, you can hold them accountable. Then you turn it to us. And, I've had conversations with many people on this panel about this issue. Incentives need to change. I think the way we're measuring performance needs to change. The idea that, again, it's all about short-term alpha is a problem. And if you start to unwind the intermediation between the end investor and the public company, and how we're all trying to hold each other accountable and micromanage that system, it does breed short-termism, and it really does breed any effort against all of this transition that we're talking about, because people are not incented in a way that actually measures long-term success, especially around climate. So, I think it's about system thinking. That's why it's both daunting, but almost exciting to think that that this is what's going to push us to force us into changing the system.
Yeah.
It has to change.
Let's take one more from online.
Yeah, from the audience then. So very relatedly, but more specifically for Carol, a question came in about how MFS actually evaluates the climate risk in a particular investment and how you compare that to other risks, like in a practical way when you're making investment decisions. And then there was I'll just throw the second one out while I have the floor, which has to do with how all of this is going to affect companies and how it figures into ESG indices, but that's kind of a separate question.
I can do
Yeah.
Those are my two questions.
Yeah, I mean, I think from the investment perspective as analysts and portfolio managers, it's getting a lot better because data is getting better. And so as you think about, and again, we do not see this as a separate thing in how we're evaluating companies. This is integrated in all of the capability and research that we look at from risks across any company that we own and factored in at that level. And what we spend a lot of time on is analyzing the data. We've been analyzing carbon data for years. This is not a new thing. When we think about, CDP disclosure project and all the efforts 12, 15 years ago, it's all been a part of measuring risk. But then you really have to weigh the trade-offs in terms of the risk to the future of that business. And this is why time horizons matters. Because for us as long-term investors, that's why we believe climate risk is investment risk, because we think it virtually affects every business we own. And so we have to evaluate through the process of them improving and becoming less carbon intense about how that's going to affect their business. So it's not a clean answer because it's one that's very complicated. And the last thing I would say, it's not all about the data. It is judgment and a lot of qualitative assessment and evaluation of how well a company is going to change. And then factoring that into your analysis.
And then just to the other question you raised about, ESG information and ESG analysis. I mean, that the issue with an ESG analysis, like where you see MSCI providing an ESG score or rating or ranking that's attached to like a BlackRock, index fund or something like that, is that they're taking a whole raft of different ES and G issues, from climate change to gender equity on the board to policies for assuring customer health and well-being and all of that is being combined into a weighted linear average of some kind to compute an ESG score. And so the degree to which they even weight climate at all is very different across the different rating agencies, as is what they're looking at as the climate number. Is it about actually emissions? Is it about, do they have a policy? Is it about, do they disclose risks? There are different ways of assessing climate, and those are all sort of washed into these big scores. So when people are doing a kind of simplistic quantitative analysis of ESG, it's a very blunt and poor instrument for assessing climate performance. And you want to be able to kind of look at it in the more nuanced way that Carol's describing. I'm looking at the clock and I'm seeing that we've reached the end of our time.
Yeah, I was looking at you, like, I don't know what we decided, but everyone's been very patient, so you can take everyone can have a final word or whatever. It's your show.
Yeah, no,
I
no.
won't take any more questions.
I mean, there's no, no, I appreciate that. I mean, there's no possible way I can try to sort of summarize all of this. I think the way I could summarize this is that there's some real complexity here. This is from those of us who sort of think a lot about climate change, this is an exciting move because it potentially sheds light on the emissions that exist in the private sector. And that light may actually make its way into the corners and shadows of the private markets through some of these scope 3 type mechanisms. And these cost benefit considerations and the implementation challenges are very significant, as are the legal challenges of how this fits into the scope of the SEC. So I think these next few weeks are going to be very exciting as we watch all of this unfold. Certainly big potential and some major challenges to overcome. And I'm incredibly grateful to our panelists for making visible some of those challenges and bringing this topic into the broader MIT conversation. So thank you so much to our panelists first. To our audience members, both here and online, and to the